Over the last 15 months, three forces shaped U.S. biotech, and understanding them is the key to what comes next. Sentiment and seasonality are familiar features of biotech investing, but surprises are the wild card that can flip the tape in either direction. Those surprises tend to fall into three buckets: policy shocks, regulatory shifts, and clinical events, each capable of rippling far beyond a single stock. Late 2024 set up a strange tension. The tape felt heavy, but expectations were anything but low. Biotech ETFs were stuck in constant breakout or breakdown mode, yet M&A optimism and hopes for improvement kept investors hanging on rather than walking away. BCC flagged a seasonal sequence worth watching. October weakness giving way to a stronger November through January window, boosted by the San Francisco conference and a reset in positioning. A clearer rate path acted like a release valve, loosening pressure on long-duration biotech valuations, improving M&A prospects, and lifting overall risk appetite heading into 2025. The first half of 2025 was supposed to build on that optimism, but policy headlines kept hijacking the story before science ever got a chance to speak. The year opened with an XBI bounce on JP Morgan buzz. Then February brought RFK Jr. at HHS and tariff anxiety. March delivered the shock of FDA Chief Peter Marks resigning, and the sector slid to spring lows. Here's the irony. FDA approval output actually stayed solid by historical standards, yet market confidence crumbled over uncertainty around timing and consistency, especially for cell and gene therapy. When Vinay Prasad was lead SEBR, fears of a higher regulatory bar reignited. The May rally collapsed, and biotech's unloved reputation became a self-fulfilling cycle. Then, something shifted. By late 2025, biotech stopped being the problem child and started looking like a possible leader. Unlike the frenzied 2020 surge, the late 2025 rally felt earned and deliberate. Powerful, but with investors constantly checking whether the move could actually hold. Summer seasonality, stacking medical conferences, and improving earnings clarity all converged, pushing sentiment from purely defensive to actively watching biotech for upside. Biotech's historical calendar pattern is consistent. A weak first quarter prone to false starts, then stronger Q2 through Q4 as proof points stack up and capital comes off the sidelines. And 2025 was the clearest example yet. A sharp early stumble followed by a sustained back half advance once the sector found its footing in spring. Strong prices told one story in 2025, but the liquidity picture underneath was more nuanced and worth looking at closely. XBI outpaced IBB with a roughly 34% gain versus 27%, reflecting its higher beta tilt towards smaller, more volatile names that led the charge. The financing window reopened through IPOs and follow-on offerings, clean signals of fresh demand. But rights offerings added a wrinkle, hinting some companies still leaned on existing shareholders rather than attracting new ones. About $47.6 billion across 695 transactions made 2025 the busiest biotech financing year in recent memory. Impressive, but confidence was rebuilding, not fully restored. IPOs and follow-ons signaled genuine new appetite, while rights offerings suggest some companies couldn't yet stand on fresh demand alone. Two very different stories inside the same rebound. M&A deal value bounced back to roughly $136.6 billion across about 1,168 deals in 2025, a clear step up from the softer 2024 volumes and proof that strategic appetite never really disappeared. The catch was in the price. Average premiums fell to the low end of the 10-year range, around the mid-20s, meaning deals got done, but buyers held the leverage. Several forces pushed premiums down together. Cash-strapped biotechs prioritizing survival, more disciplined acquirers, and a deal mix heavy on smaller tuck-ins and earlier-stage transactions. Now let's look ahead, because 2026 comes with its own set of curveballs that could test how durable this recovery really is. The biggest risk is a confidence relapse, triggered by a quiet M&A January, renewed FDA leadership turbulence, or unresolved policy shocks on pricing, vaccines, and manufacturing. If the San Francisco Conference Corridor passes without a notable deal, the market can quickly read it as buyers staying selective, and that alone can tighten risk appetite and make liquidity feel scarcer than it is. A handful of large, later-stage venture rounds lifted the 2025 headline numbers, but seed and Series A funding stayed tight, and biotech lost ground to AI for early-stage dollars. A real gap between the surface and the pipeline. Venture funding and the IPO pipeline are directly connected. If early-stage dollars stay narrow today, the next generation of public market candidates and M&A targets simply won't be there tomorrow. When FDA and HHS headlines swing week to week, investors demand a higher risk premium, and that compresses multiples and raises the cost of capital even when the underlying science is delivering. 3 policy fault lines remain unresolved heading into 2026. A fragmented state-by-state vaccine landscape, a 2-system drug pricing world under IRA and MFN running in parallel, and reshoring pressure adding real manufacturing costs. Investors don't need perfect policy outcomes. They need clarity and a stable rule book. Because without it, biotech's cost of capital rises even when the science is working. After a strong 2025, the natural question is whether biotech valuations are stretched. And the answer is more reassuring than you might expect. The NASDAQ Biotechnology Index price-to-book ratio sits at roughly 4.9x, nearly identical to its 10-year average of 5.0x, a clear sign the rally didn't push valuations to euphoric extremes. Price-to-sales tells the same story from a different angle, about 6.5 times today versus a 10-year average of 6.6 times, confirming the sector re-rated without inflating to an obvious premium. Those index averages look balanced, but they blend profitable large franchises with cash-burning innovators, and a handful of mature revenue generators can easily skew the picture at the surface. The next leg for biotech likely depends less on sentiment-driven multiple expansion and more on execution, deal terms, regulatory clarity, and companies actually delivering the proof points that keep investors convinced the re-rating is real.